Thank you. Thank you to the Money Show for having us today. And thank you for all of you that have taken time out of your busy trading day to come and talk to us, or listen to us, I should say. Today, we're going to talk about trading and hedging in today's hot commodities. And that title is pretty ambiguous for a purpose. We never really know what exactly we're going to talk about until right before the presentation, because markets are moving very, very quickly. And nobody wants to talk about a market that's not doing anything. So the image on the front screen that I was just showing you was crude oil. We're probably going to skip crude oil today because literally nothing is happening in crude oil. Although I will mention that we are still perpetually bearish. We've been bearish for roughly 3 years since the 2022 high. I think crude oil has to at least see the low 50s, but probably a 40 print before we get some sort of footing. I know there's a lot of fundamental stories that are bullish for crude oil, but sometimes market dynamics and trader positioning and things like that have to wash out before we can get to the other side. And I think that's where we are in crude. My name is Carley Garner. I am a futures and options broker at Carley Trading, and I also write a newsletter. Our brokerage clients receive the newsletter for free as long as they're actively trading with us. But if you are somebody that doesn't want to trade futures and options, or you already have a broker and you're not interested in switching, we now offer subscriptions to our newsletter via Substack. So if you go to decarleytrading.substack.com, you'll find us there. You'll also find us on all of the social media outlets. I overshare pictures of my dog. This is Frankie. We are in Las Vegas, Nevada. And yes, that picture was taken in Las Vegas, 20 minutes from my house. People think of Las Vegas as a desert, but we are surrounded by mountains, and it's actually very beautiful. Real quickly, I'm a broker, strategist, and author. I do spend some time on RFD TV. If anyone watches The Cow Guy Close with Scott Shellady, I do that once a week, and we talk about ag markets and crude oil and gold and all those sorts of things. I also contribute to Mad Money, Bloomberg Television, Schwab. And last but not least, I've written multiple books. If you go to Amazon or any book outlet, you can find them. Amazon's the cheapest, but you're going to see all kinds of other crazy titles on there, different versions of these books. Ignore all that stuff. Do not buy some of those out-of-print books that are going for a couple $100. That's totally crazy. There's nothing in there that's that exciting. But these books are the newest and hopefully the best and most current. So one more thing, I just want to make sure everybody understands what we're talking about here. I will be talking about some hedging and portfolio hedging and diversification, but most of you, or most of the people that come to the commodity markets, are generally speculating. Speculating is not for everybody. Speculating is very risky. I would say speculating is probably not for most people, but there are people out there that have the risk capital and have the time to dedicate to the craft and are willing to give it a shot. And if that's you, futures and options offer some really great opportunities. I'm not going to spend a lot of time on the next slide or two because, well, first of all, I put this in almost every presentation and it gets a little repetitive. And most people are probably thinking to themselves right now, why the heck does she still have these slides in there? Well, the reality is not everybody's familiar with this. Some of you are probably joining us for the first time and you've never seen these ideas. So I just want to throw them out there. You can email me at cgarner@decarleytrading.com and I'll send you a copy of these slides so that you can have this list. But basically the idea is, if you are somebody in the market for speculation, commodities, and when I say commodities, I'm talking futures and options on futures, is a very attractive arena for that type of market participation. Now, again, this isn't like slow and steady investing. This is trading. There are two different things. But the nice thing about futures and options is they trade almost 24 hours, 23 hours. You have free leverage. You don't have to borrow shares or borrow money from your brokerage to use leverage or go short. There's low account minimums. And there's tax benefits. If you're trading commodities, you're going to be taxed at a lower rate. And the filing is much simpler. You just fill out one form and you report a profit and loss to the government, and that's it. There's no reporting of individual trades, no paying a tax accountant to file hundreds or thousands of trades. It's really, really simple. So first of all, we're going to talk about a big picture in financials. Basically, this is kind of the macro view. I'm going to start with this. Is the Mag 7 worth more than China? Well, if you look at market cap of the top 10 stocks in the US, and specifically the Magnificent Seven, you'll see that right here. The market cap of these 7 stocks is larger than China. And this is kind of crazy because China is a massively large country in terms of population and even in terms of spending. I mean, that's why our farmers and ranchers and commodity producers love China as a customer. Now, I'm not going to go off on a tangent, but I will say China's not a convenient and lucrative trading partner, but they're not a good partner. But in any case, we chase China's business because they are so large and they have so many consumers. So to me, when I see this, it's a red flag. Something's not right. There's something's getting lost here. If we, I'm not saying that the Magnificent Seven isn't worthy of high valuation. I'm saying it's probably not worthy of this high of valuations. I think the market's really gotten away from itself. Now, you could have said this a year ago, and that would have been a true statement as well. These are bigger, longer term views, might not help you trading in the next week or so, but it's really important to keep this in perspective. What we're trading, what we're investing in, why we're doing it, because it will matter eventually. And I'm sure many of you have seen this chart or something very similar. And I'll admit this is a chart that was created by AIs. It may not be 100% accurate, but the idea is very accurate. And the idea is the indices are very misleading. If you are someone that had invested in a very diversified portfolio, not the S&P 500, but a wildly diversified portfolio, basically textbook portfolio, the type that I learned in finance class was the only way to go, those folks would be seeing probably something similar to these returns that we see at the bottom of the page down here. Unless you're holding an index such as the S&P 500 or the Nasdaq that owns the top 7 to 10 tech stocks, you're not experiencing this, you're experiencing this. So we've got a really big disconnect. Now, it's amazing for those people that have been long the right tech stocks and have made a lot of money. But I can say, and I've been saying this for a while, and April was kind of a rough time frame, and it got people like me that were mostly on the sidelines waiting for our buying opportunities to get in. But I'm back to where I was prior to April of last year, where I'm in mostly cash or treasuries or something that's not going to be wildly risky. And that is simply because I have my own scars, but I've seen relatives and friends through the dot-com bubble and the financial crisis holding portfolios that are simply much riskier than they believe they are, and it ending very badly. So while it's true the stock market almost always, or actually historically, the stock market's always gone up. If you look at the indices over time, there's some corrections, but it always goes up, right? But if you look at individual stocks that carry those indices higher from time to time, those individual stocks that are carrying the indices are different in every cycle. But those individual stocks rarely make it to the next cycle. If you look at the dot-com bubble, WorldCom was a stock that just couldn't do no wrong, and they went bankrupt. So just because the Magnificent Seven is bringing us up higher in this cycle doesn't mean those stocks are always going to do the heavy lifting, and it doesn't mean those stocks are going to survive to the next cycle. So always, always, always understand what you're holding in your portfolio and what your risks are. I personally believe there's a lot of people out there that are holding a lot more risk in their portfolio than they understand that they are. And what I mean by this is if somebody is systematically every paycheck or every month putting money into their retirement account into an S&P 500 type allocation, which is what a lot of ETFs are, index ETFs, they are putting, for every dollar they put in, 35 cents of that is going into the Magnificent Seven stocks. So 35 cents of that is going into tech stocks that have blown the doors off performance-wise in the last couple of years, but history suggests that's not how it's going to work out going forward. And this is a similar chart looking at world stocks, not just the US. So this isn't just a US issue, this is a global issue. Tech stocks are wildly valued compared to all the other stocks in the economy. I personally think that basically a two-tiered economy or a two-tiered market where a few people at the top are making all the money and everybody else is just kind of languishing and suffering. And I think that can kind of describe everything. The economy, the markets, all of it. How long it persists, nobody knows. But I think it's important that we understand where we are in the cycle. This probably isn't a time to swing for the fences. I know swinging for the fences has performed very well since the April lows. In April, if you were very, very uncomfortable as the stock market was sliding lower, remember what that felt like, because you're getting a mulligan. We are massively higher than we were, well, at least in the Nasdaq. This is a Nasdaq chart versus, this is an S&P chart versus Bitcoin. We are wildly higher than we were at the highs going into that April correction. See, we were here around low 6,000s, and now we are in the high 6,000s. But if anybody would have told you in April you'd be able to take some profits off the table or hedge your portfolio with the S&P at 66, 6,800, you probably wouldn't have believed him, right? Nobody in the world believed we were going back to 7,000. I mean, there's a few people, but the masses were panicking and liquidating. If you were uncomfortable here, that's a sign that maybe we need to do things a little bit different on the next time around. And I promise you, at some point, I don't know when, I don't know where, but this market will go into a deep correction. And even if you think you are diversified and hedged and allocated correctly, there's a good chance you're probably holding on to a little more risk than you actually think you are. Going back to this slide, it's really important. We don't really do a whole lot of Bitcoin trading or anything with Bitcoin. I think I'm too old for this asset. I see zero intrinsic value. I see zero currency value. I've read and heard all of the reasons that Bitcoin is supposed to go up, but all I can think of is Beanie Babies or, to me, it's just I think it's all sizzle, no steak, but we will find out. History will tell. I could be completely wrong. I also want to mention NFTs. It wasn't that long ago. NFTs were the big thing. Remember, people were buying digital images on the internet and paying millions of dollars. I don't know if you've looked at the NFT market, but some of those images that were going for multiple millions of dollars are now going for 20, 30,000, which, to be fair, is still, in my opinion, overly priced for an image on the internet, especially when in a world of AI where you can really create any image you want pretty quickly. With all of that said, the one thing that Bitcoin does very, very well is it tells us where risk takers are, or where their minds are. Bitcoin tends to top out before the S&P does, usually a month, but it can be 2 weeks and it can be 6 weeks. It also tends to bottom before the S&P. So ironically, Bitcoin is kind of leading the risk taking in the S&P. You can see that it's kind of been habitual. Bitcoin tops out, stocks follow. We may or may not be, we don't know yet, but this time around, in late 2024, when Bitcoin topped out, it eventually drug stocks wildly lower. Now, this should be concerning. If you're holding a lot of risk in the stock market, this is very concerning to see Bitcoin do what it's doing. Not because you have Bitcoin exposure, maybe you do, maybe you don't, but because eventually, unless Bitcoin does something dramatically in the next couple of days, or let's say the next week, to move back above 100,000, eventually this is going to pull the S&P down, and we're all going to suffer. Why Bitcoin leads is there's all kinds of theories. My theory is Bitcoin is the ultimate risk asset, and what we see in price action in Bitcoin is probably just very indicative of where the country or where the world is or where investors' minds are in regards to taking on risk. And you can see the risk aversion starting to bleed out in Bitcoin, and the stock market may or may not be next. Now, there is kind of a caveat to that. Stock market almost always goes up over the holidays. Even during the financial crisis, the stock market went up over the holidays. So I actually do think we are in a bit of a 2021 scenario where we have kind of an ugly October, November, and then we put in one more new high or one more retest of just under the highs. So I'm not bullish the stock market, but I do recognize that it's very rare for the market to go down this time of year. So take that with a grain of salt, but it's important to understand seasonality and the odds. So the Russell 2000 is an index that's obviously much, much bigger than the S&P 500, obviously. 500 stocks versus 2,000 stocks. But what's important here is, and I will mention, the Russell represents smaller stocks, lower market cap, so it is a different animal. It's generally not tech, it's generally oil and gas, banks, things like that. But the purpose of this slide here is to recognize that in the past, the Russell and the Nasdaq were generally correlated. Not always. It broke sometimes, but before the AI boom, they were generally correlated. You can see on the bottom left-hand side of the image, there were times where the Nasdaq outperformed, and then there were times where the Russell outperformed, but they really kind of corrected each other and came back into line. However, since the AI boom, that has not been the case. Since the Nasdaq has started to run on basically the idea of AI being the next frontier of technology, and maybe it will be, but the euphoric speculation has put us in a situation where these two indices have disconnected in a way that they never have before. Can it persist? Can 7 to 10 tech stocks completely blow out the spread between two indices? Sure, it can persist. Again, we could have said the same thing last year. This is going into late 2024, and you can see there obviously a very big spread there. But I do believe at some point these two are going to have to come in line and come together somewhere in the middle, which would mean Russell would outperform and Nasdaq would underperform. So be on the lookout for that. And I'm not a portfolio advisor. I'm not going to tell you how to structure your entire portfolio, but I do analyze markets, and we do use futures and options to hedge these sorts of risks. So if you have a lot of tech stock risk, this might be a time to hedge it. While if you have Russell risk, maybe don't hedge it at all. So I'll just say one final word. This is a weekly chart of the Nasdaq. In my opinion, there's a lot more risk to holding tech stocks here, or stocks in general. When I say tech stocks, I'm actually also talking about the S&P 500, because we just mentioned that the S&P 500 is basically being dominated by 7 stocks. The other 493 really haven't done anything for years. So when I say tech stocks, I'm actually talking about most indices that a lot of you are investing in. So be very careful. This can continue to go up for who knows how long, maybe weeks, maybe years. I have no idea. I wish I did. But what I can tell you is if we start breaking down between under 23,650 in the NASDAQ futures, and this is the NASDAQ 100, that puts us at risk to a much, much bigger correction. So we're not there yet. Right now, it's kind of run-of-the-mill pullback. No reason to panic. But below 23,650, it starts to get scary. The thing about this business is you want to hedge and prepare for the worst when you can, not when you have to. So I really encourage people to maybe rebalance their portfolios, or maybe utilize futures and options to hedge their portfolio risk in a manner that gives them some upside ability, but also takes away some of the downside risk. I've shown this slide multiple times at the Money Show, and I'm going to show it one more time, and I'm going to be really, really, really quick. And I know a lot of people think Warren Buffett is washed up, but he is the GOAT. Until we have more wealth accumulated than Warren Buffett, we really can't criticize, right? So whatever he's doing has worked, and what he's doing is a lot of things, but from a very, very simple viewpoint, he does use this Buffett indicator, which is the total US stock market over gross GDP. And a lot of people are criticizing this because they're saying the economy is more of a global endeavor now. It's not individual countries, but even so, even if you want to shave a few points off the index just for that, the reality is the stock market's wildly overvalued based on the Buffett indicator. In other words, we have very high price stocks, and we're not really producing a whole lot in goods and products. And I'll add one more thing to that. I just got done telling you that most of the stock value is made up of 7 to 10 stocks. So this is probably even more extreme and more obscene than it looks here in this simple chart. This is a monthly chart of the NASDAQ. I too have shown this one multiple times at Money Show, but just giving you an update, and I'll be very, very quick. Some newer market participants think that this is how markets behave. You buy the dip religiously, it's always going to work out. And that can be true. But what you have to recognize is after the dot-com bubble, there was 10 years. Well, actually, in the NASDAQ, it was more like 20. Almost 20 years in the NASDAQ of drawdown. We've been programmed here in the last couple of years to think drawdowns are a couple of weeks or a month or two, not years. But the reality is, if you're in the market long enough, eventually you're going to be there for one of these 10 to 20-year drawdowns. And that's going to be very, very frustrating. So it's important to recognize where we are in the cycle. If you're putting new money to work in this market, just be aware of where we are. If you have 20, 30 years till you need the money, then who cares, really, to be honest. I mean, I still probably wouldn't put my money in a market like that. Even if I did have 20 or 30 years, I'd probably be a little more cautious up here. But if you are someone like me that's older, and I'm not going to retire tomorrow, but I also don't want to suffer a 10-year drawdown that makes me think I can't retire when I want to. So, be very aware of where your portfolio is, how much risk you're actually taking, and whether or not you're in a position to accept that risk. And if you aren't, there's things you can do to hedge, and we're going to talk about a few of those real quick. I'll just say this one last thing. If you think that the stock market always goes up, and you're right, it generally does, just recall what happened to Japanese investors. The Nikkei index peaked in the late 80s, and it didn't get back again until just recently. So we're talking 30 years. I'm not trying to scare anybody. I just want everybody to understand what the risks are, because I see a lot of people on social media talking about, don't pay off your car, don't pay off your credit cards, just put it in the stock market. You'll be better off because the math works out. And the math probably has been working out, but the math doesn't have to work out forever, and it probably won't work out forever. Let's talk about gold real quickly. There's obviously a lot of reasons that people are interested in buying gold. One of them is inflation. I would like to point out that if you're looking at commodity inflation, now I know there's other types of inflation, but commodity inflation is actually quite benign. In fact, it's actually very, very low. If you look at the Bloomberg Commodity Index, which is what this is, we are nowhere near the 2008 peak, which is when crude oil was at 150, natural gas was at 13. And if even crazier, if you take out precious metals from the index, we're probably trading at where we were right around the COVID lows, probably a little higher than COVID lows, maybe like the 2019 lows in here. So I understand there's inflation in some parts of the economy, but it's not in commodities, unless you're a live cattle trader or a rancher. Beef prices are high. Most prices are low. So I'll warn people, there's a lot of expectation that gold and Bitcoin are diversifiers from the stock market, but they are not. I really hope, if you get anything from this presentation, I hope that you realize not only is the S&P and the Nasdaq very weighted to a few stocks, but gold and Bitcoin are trading as if they're a very similar risk asset to stocks. Prior to the stimulus injection of 2020, prior to the pandemic, that wasn't the case. They did their own thing. They had their own fundamentals. But following the stimulus injection, all of that money that came into the economy eventually makes its way into the markets. At first it goes through several hands, people spending it and doing this and that. Eventually it lands with a saver, and that saver puts it to work in the markets. And if there's too much money chasing too few goods, you see this type of correlation where gold, Bitcoin, and stocks all go up together. The problem with this is there's a pretty good chance they all come down together. If we get a big liquidation event, which is starting in Bitcoin and may end up dragging the others down, all three of these assets are going to underperform. Or let's just put it this way. It's like musical chairs, and there's not going to be anywhere to hide. The only place you might be able to hide is treasuries. Treasuries are wildly undervalued. This is one that's been baffling me. I've been waiting for treasuries to make a move, and they just have been languishing down here. But it's kind of really crazy because we had this massive rush into gold, almost identical to what we saw in 2020. But in 2020, the risk asset was treasuries. We see everybody wanted to own treasuries up here. This is a 0% yield. I think this is a 30 years, so technically it was like a 7.7% yield, so less than 1%. Everybody wanted to buy treasuries. But this time around, the risk-off asset was gold. For whatever reason, investors chose gold, and they've done the same thing. I suspect in 5 years, if we look at this chart again, all these people that bought gold would have wished they would have bought treasuries, just like in 2020, everybody that bought treasuries up here probably wishes they would have bought gold instead. Sometimes market participants are all on the same page, but that doesn't mean they're all right. And one last view of gold. Now, I don't know if you've been following us on social media or following our newsletters. We did get gold wrong. We were expecting gold to hold this area here. We were expecting gold to be a repeat of 2011 bull. It was not. It was a repeat of the 1979 bull. So this is what we got. But I will tell you the outcome's probably going to be the same. I know it seems crazy, but in 1979, gold had this parabolic run, very similar to what we had now, and it gave back almost all of it. I think it was eventually a 70% correction. So don't be shocked if we see the air come out of gold. And as I just pointed in the previous slide, stocks, Bitcoin, and gold might all go together. And I know we're running out of time, so I'll just point this chart out one more time. This is a 30-year bond. Nobody wants to buy bonds because it's very unpopular. But sometimes the least popular move is the right move. Just like we saw in 2020, buying bonds was the most popular move. That was the worst thing you could have done. In this cycle, everybody wants to buy gold. That's the most popular. I think that's going to be the worst thing you could do. The one that nobody is touching, nobody's talking about, might be the best investment for the next 5 to 10 years, to be honest. And we're pretty short on time, so I'm not going to really have a chance to go through some of our examples, but we do have the ability to, you can sign up for a free newsletter trial on our website, decarleytrading.com. You can also go to our Substack page where you will find all of our newsletters and even our trading ideas. So if you can go to decarleytrading.substack.com, you can subscribe to these. We do charge $25 a month for the newsletter itself, so beware, but you'll get all of our information. That way, if you don't trade futures and options, you can have access to our information without opening a trading account. But of course, if you do trade futures and options, we'd love to have you at our brokerage.